All right, I wanted to start off with some things that I kind of live by. I've got some of these pictures posted up around my my trading desk in my office, and these are things that you tend to forget every now and then, but it's good to have it. It's good to have it posted where you can where you can see them every day. So number one, it's all the process, and one of the things that I think we can kind of try to stay away from during trading is to stop thinking, right? So when you go from analyzing and trading, it's two different parts of the brain, I think, right? So when you're analyzing, you end up being slow, you end up second guessing yourself, you end up making bad decisions, second guessing yourself. So I'm hearing an echo if somebody else is on here. But number one, it's all the process. So stop thinking of the results, only focus on the process. And I was watching the Olympics this week, and I heard that from so many of the Olympic guys when they asked them what it was that got them there. And they don't think of what the result is going to be. They just focus on the process. And that's something that's really helped me with trading, which is you put together a game plan, you stick to the game plan, and you don't change what you're going to do when the market gets there because you start overthinking. Consistent action ends up giving consistent results. If you can't log it, if you can't log your trades and see what mistakes you're making, then it's not really a system, then you're just kind of winging it, right? So to have a schedule, I know some of these guys talked about times of the day and stuff like that. There are certain times of the day where I'm just not good, and I tend to stay away from those times. I remember on the floor, you have a winning trade on, you'd actually have to walk away during those times. Am I okay? Somebody else is on because I'm hearing some reverberations. So, yeah, I don't know why I'm hearing this, but the schedule is the system. So look at your strategy, know what your strengths and weaknesses are, keep a trade log, keep it.
Testing.
I'm on, but can you hear me now?
I can hear you now, and you sound good now.
All right, back to it. How you trade reveals a lot of what you think of yourself. This is a big one for me. If you're flip-flopping and unsure of yourself trading, you're probably that way as a person, and you need to fix that. One thing that I like to think about is what can go right. You always know where your risk is. That's a given, right? You're going to buy it here, put a $3 stop in, put your $3 stop in, and let the trade work. If you're wrong, you're wrong. You mark it on your log that trade was a loser. But I try to make more than 2 or 3 handles on a trade. I'm looking for at least an 8 to 10 handle move. Because I don't want to have my support and resistance level so close where I'm literally getting either chopped up or flip-flopping back and forth. So number one thing for me, stop thinking. Let me get rid of that. Before we get to that, this is what I put out every morning. It's called the Daily Gameplan, and it's my interpretation of what's important for the day, what the key levels are, And at the top, it's what's the game plan? What are the key areas? What are we looking for? A brief synopsis. Let's in equities, rates, energy, metals, and currencies. Now, I'll track everything, and I look at things relative value to each other. Excuse me. I put some new trade ideas and active trade ideas. New trade ideas, I'll put in, for example, we want to be long the Russell above 1515. We want to sell it when it breaks. The target, if it breaks, is a substantial target. The S&P, we want to be long above 2710 with a tight stop. This was from yesterday. But those are the type of things that I put out every day as far as there's the game plan, there's the trade ideas that I'm looking for. You get some of the highlights that and data points for the day, something that's happened overnight that maybe is important. So when you get this, you say, oh, I didn't see that, or just some simple news. And then I give resistance, support and resistance levels in the E-mini S&P, the 10-year, gold, crude oil, and the dollar index. So a lot of people ask me, how do you trade these levels? When I was down on the floor, I used to have the levels like on a card, and you stick in your pocket, and some of the locals would come by, and you jot the numbers down, and then when the market's moving, you pull that card out and you take a look. So I take a snippet of this, put it on my screen every day, and when it gets to a level, I know that it's a level that I should be aware of, and possibly whether I want to trade that or not. I'll give you. This is today's. Really quickly, I'll just show the E-mini S&P, some of the levels. The type of accounts I talk to, not necessarily day traders, although there are some. I talk to a major bank, and their guys are day trading it all day long. I get a lot of feedback from them. I talk to some pension fund guys. They're not really interested. And I remember when I was covering the SAC guys, and you would say, sell them here with a $3 stop. They're like, $3 stop? It's going to take me 20 handles to enter a trade, So I start off by looking at a little bit bigger picture. Every day when I walk in, I look at the weeklies, I look at the dailies, and then I go down to the hourlies and the 5 minutes. But this is a simple S&P chart. A brief little synopsis. There's something about the SPX. Now in January, it was interesting because the RSI was above 75 for 18 consecutive trading days, which was an all-time record. So we knew that there was some froth in the marketplace. And when it broke back below that RSI, obviously the inverse volatility crisis hit shortly after. But we were at least aware that there was probably some reason to be short the market and put out something as far as on that daily picture type thing. We look at the NASDAQ. That's the VWAP. Is that yellow line? That's the VWAP from the high. For right now, we're willing to be long NASDAQ as long as it stays above that VWAP. The Russells. We're long above 1517, 1515 area. The Dow Jones, everybody's talking about the 50-day moving average. It hasn't really been a huge star point for me, but it did trade up there a couple of times since it broke. Hasn't really had a good settle above it. Just something to really quickly look at this and you go, okay, so S&Ps have come a long way. They're near that February 2nd, February 6th breaking point for the vol crisis. We're not really willing to be aggressive buyers up here. The NASDAQ's holding above that level. It's been leading. Small caps have actually been holding in there. What we would normally look for when the market was in trouble would be, especially during certain times, that small caps should be leading the market lower, and so far they've been hanging in there. The VIX, when they had that vicious spike, it's come back. I love 786 retracements. I always want to know where they are on a short-term and longer-term basis. I'll show you some of those in a few minutes, but the 786 around 17.5 also was right around that August high, and right before the FOMC minutes, we did see vol get crushed a little bit below 17, and then it quickly came back. So just to let kind of a quick synopsis, We still think there's some volatility in the market, and we've got 17.5 as kind of an area that we can look at. Some of the market leaders of recently have been the financials. They've waned a little bit here in the last couple of days. There's a reason for that, but XLF settles right on its 50-day moving average. It's been a pretty good pivotal point. So we'll look at that and say, all right, so the financials have come off, but they're still hanging in there pretty well. One of the things I wanted to talk about today was rotation. And when we were in January, the thing that happened was there was no rotation all of a sudden. And all through 2017 and most of 2016, the entire market was grinding higher, and it was primarily rotation. The correlations for the 11 different sectors of the S&P 500 were below 50% and some even below 35%. If somebody wanted to be short the market, they either got fired or you had to be willing to get short a sector and long something else. So I did a lot of work for some of the pension guys and some of the hedge fund guys on the energy space. Energy, as everybody knows, first half of last year was getting crushed. It did find a nice last 4 months of the year. It did get a nice lift. And was there rotation into energy, and was it out of XLF, and vice versa? So I like to look at everything at least once a day or every other day, XLE versus XLF versus XLY versus, you get the point. A quick look at the DAX. It's holding below the 382 retracement. It's still negative below the 200-day, which you could see back in August. It had a one-day blip below it, settled back above it, and held it for a few days. So the 200-day there is still pretty important, and we're negative the DAX overall. The Shanghai Composite reopened, and it's climbed right back to its 200-day, which in December had multiple, I think it had like 6 or 8 days where it actually touched the 200-day and held. Then we get to what I call the tactical allocation relative value strength. So I like to look at all of the markets relative to each other, S&P relative to the 10-year, relative to gold, to copper, and crude oil, and then kind of make a little gauge as far as where do I really think, is the market, for example, here, crude oil seems like the strongest market for me today based on what we were looking at in relative value. So one of my initial things was, I want to sell the 618 retracement in crude oil today at 63.15. And I'm like, why would I do that if it's my most positive sector in the relative value section? So puts you back on the right side of the trade type thing. That relative value strength model is based on a short-term 3-day. It's not something like we've been short this for the last 3 months. I update it daily, and it's kind of like what's going on in the short term. Passive investment strategy. This is being long TLT and long the SPY, right? So literally since the financial crisis low in 2009, you couldn't go wrong being long both TLT or the long bond or 10-year and being long S&Ps at the same time. Well, that was starting to get a little frothy itself. There's another chart here that I'll show you, and this is the 10-year future. This is long long the 30-year future and long the S&P, and it trended higher all of 2017. And right at the end of January, it hit the top of that, and we were saying, look for at least a little bit of a pullback here in the passive investment trade, and it came all the way back sharper than we really were kind of anticipating at the time. But once it broke through that bottom part of the channel line, it fell all the way to the 618 retracement of that entire move. And it just so happens that it was also, if you can see the S&P chart here, it was also the same time that S&P was hitting its 200-day moving average. So I like to look at things in a couple of various ways, that you look at 30-year versus S&P, 30-year plus S&P. The feeling here was the passive investment crowd was getting lazy. They were getting complacent. It was just too good. Something has to give here. You've got rates. All of a sudden, the long end is starting to pick up a little bit and yield, and you've got some concerns there. When did they start to feel a little bit of pain? So when it hit the 618 retracement of that whole move, you said, okay, this is probably a low. It helps us in our buying the 200-day moving average in the E-mini. It helps with getting out of some shorts maybe in the 30-year. Let me see if I can bring that thing back. Bear with me just a second. I apologize. How do I get this? Sorry. So there's the passive investment strategy. That's something that I like to look at every day and kind of get a feel for. Now, it did break. You can see from the bond chart it held a key Fibonacci retracement, but the TLT SPY got right back up to that broken trend line 3 days ago, and we still think the market could be in trouble here. It has some vulnerability as long as it's below that. If you get it back above the trend line, all bets are off. It's probably going to start to just grind higher again. But for now, that puts us on, do we want to be a buyer? Do we want to be a seller in S&Ps at this point? We're leaning towards trying to sell the rallies here. This is being long the 10-year versus being short the E-mini. And if you can see from this little line here, that's where it really broke out on that February 2nd, February 6th date. We're all the way back at that point. So if you're looking at how the treasuries look relative to the S&P, we're right back on a relative value basis where the whole thing kind of blew up. So until that line really breaks, we're still thinking maybe it's a sell the S&P type thing. 10 years probably don't fall out of bed here anymore, that type of scenario. Copper versus gold, a lot of people use it for kind of a gauge for 10-year yields. But I like to go through a little bit of everything, show some different things on different days. Copper versus gold, the 100-day moving average has been very pivotal. It's held below it, but it's right back at it, which we kind of look at when we get to see how the metals are doing. Copper versus S&P, you can see that it. Hopefully you can see that. You can see where when S&P's broke on the 6th, copper versus S&P traded up to a 786 retracement. It would then be worth selling copper, buying S&P, or it kind of gives you one of the relative value trades has kind of reached a target, and S&Ps are probably going to bottom type scenario. GLD versus SPY, I do gold versus SPY. I use CQG for my charting. It's great because you can do the notional value of the 10-year, you can do the notional value of gold versus the notional value of S&P, and it gives you a better picture in the futures for what the guys that trade the rel-val and the pairs trading in the ETFs. But gold versus S&P, holding a 618 retracement, holding above the 50-day moving average, which has been a little bit of something to kind of keep an eye on. So gold probably willing to hold in here for right now. Fixed income. This is the 5-year future. It broke its 200-week moving average back in December. It hadn't been below its 200-week moving average since 2007. Thought it was significant. It's held below it. The 10-year future broke its 200-week moving average. Same scenario, and it started to leak from there. The 10-year yield, just to give a quick update on where the yield is, the 304 area is really the high from back in 2013. That's everybody's looking at 3%. It is good above those previous recent highs, which was an actual 786 retracement. I didn't show this morning the 30-year, but here's the 30-year. And it's 200-week moving average. So it's been really good support. Here in 2014, it was the bottom. Here in 2015, on 4 separate occasions, it was the bottom in the 30-year. And here again in March of 17. And when it broke it at the end of January, that's when we thought the long end, the long bond was susceptible to a sharper move. And when it fell apart, that's when we were kind of had our eyes on what the passive investment trade might look like and how that might react. So And now the bond has come all the way off to the March 2017 low type areas on using the equalized version and getting a little bit of lift here today. The 30-year, the weekly 382 retracement in the 30-year is 3.25%. It's also the 100-day moving average. I'm sorry, the 100-month moving average. It's really a big resistance area. I'll show you that chart in a bit. This isn't today's. Bear with me just a second. I apologize. Okay. Let me just backtrack one real quick thing. This is IWM versus SPY, and I chart it with the Russell versus the S&P as well. But I've shown this a couple of times on another webinar. It's really an interesting chart because right after the November presidential elections, you saw that the small caps sharply outpaced the S&P, and from that point on, at the beginning of January 2017, small caps underperformed as we weren't sure whether Trump was going to be well received and liked, and his policies were going to be able to be put through. And small caps came off. They were a little more the euphoria from cutting taxes and repatriating kind of lost its allure, but it came all the way back to the same level that it had when it was from those November elections, which ended up being a 618 retracement. And we thought that's pretty significant. We liked buying the Russell versus selling S&P at that point. And if you had done that trade, you made about you made 7.5% in a month on that trade, which seemed to have very limited risk. If you're not trading pairs, I think it's also important because why would you want to be long S&P if you could be long the Russell at that point? Same thing is happening here again. It came all the way back to that 618 retracement, and the market broke, had a major plunge, still didn't break that 618 retracement. And I think that if the market was really going to roll over and have a bigger correction, I think you would probably have small caps leading that way. And since they're not, it leads me to believe that the market's going to stabilize here. Here's XLE versus XLF, which was something I was trying to get at before. This was the rotation, that type of rotation that we've been seeing and becoming accustomed to. The XLE outpaced the financials at the end of in December, leading up into the middle of January, hit the 200-day moving average, and then they turned around sharply from there. But I was showing clients XLE versus XLF, XLE versus SPY. It was really key resistance. It was a crowded trade. A lot of people I did work for were very much getting into that energy space and thought it was really like the next leg was to be long energy over everything else. And you can see sometimes when the trade gets very crowded, it tends to blow up. Okay. Bear with me. Sorry for the dead air. I feel like Steve Dahl. Yield curve, 210 curve. This is the short-term version. It held a 618 retracement back up to that 382. I've been showing a longer term. This area down around the 2018 lows here was a long-term, multi-year key retracement to 786. Like that area for a bounce, but just trying to show the 210. What's happening here? Is that going to influence the bank stocks, which it has and which it should? The Boone held a 786 retracement back here in July of 17, held it again here in February, got a little bit above this this descending trend line. The Boone is probably helping out the U.S. Treasuries, and that's why we thought if the Boone rallies here, it's probably going to help lift Treasuries for the time being. I go through crude oil really quickly, holding above the daily cloud support, traded up to the 618 retracement. We are looking for a little bit of a move above that. A quick view of RBOB, heating oil, nat gas, soybeans, metals, gold. I show a different picture of gold every day, but gold holding above the VWAP from the D's lows. Silver, copper. Quick look at the currencies. The dollar index holds a 200-month moving average, negative below 90.68. UUP needs to get back above that 2017 low. Just a real quick synopsis where you can kind of feel like, all right, I kind of know where everything is here. The yen hit a 618 and backed off. Dollar CAD up to the 200-day moving average. Euro yen fell all the way back to its 200-day moving average. So I like to show, within 10 minutes, you kind of get an overview of where things are on a macro basis and what might be influencing the market that I'm trading today. Here is a gold chart. Love 786 retracements, held the 786 retracement down here in December, has rallied all the way back, kind of a triple top, put in a little bit higher highs, came all the way back, held this previous high back here. But one of the things I like to look at for when I'm looking at gold, is how is gold going to act relative to S&Ps? How is gold going to react relative to maybe crude oil or something? But the most important chart is the gold versus silver chart. Silver should be leading directionally. If gold is going higher and silver is not leading, it tends to be a negative. We had 2 points where it hit the 786 retracements. Both of those times were the exact low, July 10th in 2017 gold, and then again in early December. So when gold versus silver hit the key resistance area and came off, that was a signal that gold and silver both would be higher. Now they're above that 786 retracement, which kind of takes away that significance of being long gold. So we're not really big on being long gold at this point, and that's a major reason why. Let me see. I'm going to get rid of a bunch of these things. This is a long-term view of the 10-year versus the S&P. You can see that we broke this trend line from the 2000s. This is right at the crisis levels, and when everything kind of when 10-year outpaced S&P significantly. But again, at the end of 2017, we broke that long-term kind of an important point, and that was another signal that that S&Ps are going to start outperforming or continue to outperform treasuries. Crude oil versus S&P. We can look at a longer term version. This is a shorter term chart. Like to see if the fibs are working or if they line up. You can see the 50% retracement here lines up with this high area here and this kind of breakdown area here. It just gives us a quick synopsis of do we want to be long or short crude oil, or would we rather just be long S&Ps, for example? Here's a longer term version of that. And really quickly, it's just something to kind of look at and say, do I really want to be selling crude oil here? I might, if I want to be short something, it might as well be S&Ps type scenario. Does that make sense? Okay. So what I'm trying to kind of get a glimpse of every day is what part of the market is influencing another part. If gold starts to break down here, is that a good thing or bad thing for the overall equity market? Is gold and gold stocks, are they going to start to crumble? Are they vulnerable? How does gold look like? How does it look relative to S&P? How does it look relative to fixed income? How does it look relative to copper? How does it look relative to um, crude oil? I'm trying to find a really good chart that, okay. So I had a client that wanted to be short gold, and I said, why would you be short gold when you can be short the 30-year, you can be short the 10-year, and went through a few examples of, so here's again another example of 786 retracements working, breaking the trend line, and then the 30-year just got crushed relative to gold. So that's why I like to look at it when it's right up here in this area. I don't know if you can see my mouse or not, but when it's in an area where you think, boy, I really have an opinion on gold. I think it's a short. I think it's, and this particular person had a 600 to 800 type target, and you look at it relative to the other markets, it kind of puts things into perspective, right? So I told him I'd rather be short the treasuries than short gold. This is why. He waited a couple of days. Gold rallied. The treasury started to get hit. It was all good. This big chart here, this is the one to the upper left. This is the 1 minute of the S&P. It's the first thing I look at every day is where is it in relationship to the VWAP? Is it above the VWAP, below the VWAP? There's some other things that I like to look at, maybe a 5-minute cloud just to kind of see if there's anything going on there. But I tend to use Fibonacci's, moving averages, but I'm really looking for something that works. If the fibs aren't working and they don't look like they've been working, I'm not just going to show them and just be in love with fibs because they're fibs. So I look for other things that might, price is everything, right? So if you find areas where the market has really had significant moves from that tends to be more important than a fib level. So if fib level lines up with something where we've had a major sharp move, then I put more emphasis on it. And if a fib level lines up with something that's been lines up with a fib in a relative value trade, then I like it even more. I don't know if you guys look at Bitcoin or trade Bitcoin. There's been a lot of talk about does Bitcoin, did the plunge in Bitcoin give us an idea that there was going to be a plunge in the stock market, right? So Bitcoin obviously is not really an institutional trade. Obviously a lot more volatility, but you can see there is some bit of a similar pattern where it really peaked a month or so earlier than the S&Ps did. But when it broke, it traded down to its 200-day moving average, and then it rallied from there on the exact same day that S&Ps did. So it's worth keeping an eye on. It's worth seeing whether Bitcoin is a sign of. I did a piece today on Benzinga where I talked about Bitcoin is probably more of a retail environment sentiment. So some of my contacts are, they work for big retail shops. And when you had a lot of people opening up retail accounts to trade Bitcoin at the last couple of months in 2017, and then you saw that Bitcoin fell apart, well, they had their accounts open. They might as well be trading something else. And retail tended to just plunge right into stocks in general, lifting everything, helping cause some of those correlations that I mentioned before. But here's the Bitcoin real-time index. It rallied 99.19% from its February 6th low, put in that little trend line. I think that if it holds below that cloud here for the time being, This red part of the cloud signals that it advanced, that there's a little bit more negativity. So looking for Bitcoin to kind of roll over, which if you think there's any merit to that, it's worth keeping an eye on. Real quick, this is kind of what I do for a log. I have my my goals, and I have my identify my weaknesses and my strengths. I have my execution strategy, what I'm looking to do, and then every day I post what my trades are, what happened, where did I mess up, why did I get out too early, those type of things. So I'm sure a lot of you guys do the same type of thing, but I just wanted to kind of point that out. Let's see, there's one last thing. Oh, I lost it. I am on once a week on Fridays. I post on Benzinga. If you're interested in taking a look at what some of those things look like. Here's that post today. Is Bitcoin significant for stock market sentiment? Take a look. Let me know what you think if you're interested. But I just kind of go through some of the similar things that we went through here today. There's the 30-year yield and the 100-month moving average. I posted it on LinkedIn. I got like 800 views in the first day. So that 3.25 area in the 30-year yield is going to be significant. And just kind of go through some of these things. If you're interested in taking a look at the daily game plan, you can go through MrTopStep, and there's a couple of different programs. They have free trial for 2 weeks if you're interested in it. And you can either email me, or you can go to MrTopStep. I'm Dave at KeystoneCharts.net. You can go to my website at KeystoneCharts.net. We're looking for a test of 39 here in the S&Ps. Would be a seller there first time. So that's kind of how I look at things. It seems like a lot, but when you look at everything every single day and you kind of get coordinated, it is actually fairly simple. It just kind of tries to put you on the right side of the market, and that's it. So anybody have any questions, or taking that as a no? Marilyn, is there a link that they can?
I'm actually doing that right now, looking for that. John is the keeper of links. Hang on. Nice job, David. Oh, we're zooming up here. What is going on? SpaceX takeoff.
You know, one of the things I think that's saving or is helping lift stocks today. I mean, you've got the long bond is firm. It's hanging in there. The last couple of days, as soon as the bonds turned around, is when stocks, got hit. But for the time being, as long as you can get both of them moving, or at least getting some stabilization in the long end, I think it's a positive.
Yeah, decent move, boy. Something must have happened though, because ES and NQ look exactly the same here. As they zoomed up, I went to look for news. I can't see anything.
The VIX is actually just broke. It's below 17 now, so you're getting a little bit of a VIX plunge.
John, are you out there?
Not a bad day. You got crude oil to lift. Gold is hanging in there. Not a lot happening in the small caps, but NASDAQ doing well, obviously. Not a lot of movement in the dollar.
closing MIM is just about 300 million to the sell side. So not a very big, certainly not it's the opposite direction of the market move right now.
Yeah, but 300 million is nothing, right? So it's kind of like almost like
Neutral.
Yeah. I'm also on Twitter. Am I still on?
Yeah, you are.
I'm on Twitter at Keystone Charts. If you want to take a look at some of the type of stuff that I post, and then Marlon's going to get you a link to where you can, if you want to take a look. And if you try the 2-week trial, you'll get the intraday stuff as well, which is more of a premium content thing. But if after a couple of weeks you decide that it's not for you, no harm, no foul. I don't hassle people, go after them. It's a one-time offering. Your email leaves my computer, and it's good to go. So if you want to try it for a couple of weeks, see if it's helpful. Helps with formulating your game plan in the morning. Please give it a try. Okay, can I sign off?
You can. Sorry, I was just looking at stuff. Good job. Yeah, so they're good. John put the links in there.
Thanks, Marlon. Thanks, Bob.